Hey gang, welcome to another episode of Time in the Market. I'm doing this one just because the stock market is going crazy right now, and I kind of wanted to talk about what is going on in the market. Why is the market going up so much, despite the fact that there's a lot of negative news out there, right? The pandemic still hasn't really gone away. There's certainly some civil unrest in the United States, and there is certainly record high unemployment, even though it seems to be slowing. But yet the stock market is basically almost back to all-time highs. If we just go back over here, look at the S&P 500 quote today. As of right now, we're sitting at a 31.96. It's up almost 3% today. If we look at 1 year back, the all-time high was 33.86. This was before a lot of this pandemic stuff came out. We're not that far off. And if you kind of go back to March, the downs we're almost 30 to 35% up from where we were when the market bottomed, and the recovery has been really quick. So, I mean, what's been driving that? I really want to talk about that. And I also want to talk about how my portfolios are doing. If you remember, I have two portfolios here, one that's an Aristocrat portfolio, one that's an industry bet portfolio. And just like the market, even though I haven't been putting a lot of money into this because I've been putting some money aside for a house, this portfolio has been doing really well in the last couple of weeks. We've gone from $36,000 in towards the latter part of May, and now at the start of June, the market's still open. So these values are going up and down a little bit. I'm up almost $4,000 in a little more than 2 weeks, and that's because the market in the last, essentially, since May 22nd, it was at 2955, and now it's at almost 3200. If we do the quick math here, even without dividends, we're up 8%, right? So this portfolio is up a little bit over 10% in that time frame. Some of that was additional money being put in, but a lot of that was growth, and I'll show you what I mean by growth. The industry bets portfolio especially is doing really, really well since it's so technology focused, and that's been a winner. But overall, I'm very happy with where the portfolio sits. Up almost to 40K now. Forward dividends here. Again, the Aristocrats portfolio is dividend focused. The other one really isn't. Almost $660, $650. So that's a change of $67 in forward income based on the yields I get. That's pretty darn good, and that's just additional money being put into the market and yields going up. If you can look at the historical dividends I've gotten here, it's not anything amazing right now, but you can kind of see the growth here. Last May, I had $10.66 in dividends. This May, I'm sitting at $34.88, and that's one of my smaller months. I've got June ahead, which is going to be a good month here. That's off the heels off a $45 dividend month and a $37 dividend month. So dividends are flowing in, portfolio's growing, and things are good. But you might be asking yourself, how is this market going up so much? If we look at some of these valuations, you can kind of see the S&P Schiller PE is kind of back to all-time highs again. It kind of dipped a little bit in March, but we're sort of going back up again because the prices have gone up, and earnings really haven't been that good simply because the pandemic has had an impact on a lot of industries. So the Schiller PE is trending up. And if you look at this historical mean, you may look at yourself and say, hey, we're at a 30 now. The historical mean is 16, 17 in that range. We're kind of higher than we've been since like Black Tuesday and the 2000 stock market crash. I'm kind of getting worried knowing what's out there. And, I kind of feel the same way, but then I think about it in other ways. I kind of look at, well, how has the market changed really in the last couple of years, but especially in the last couple of months? And what's driving this increase in stock prices despite all the uncertainty that's out there? And I think a lot of it has to do with what the Fed has done in response to this crisis. If you kind of look at this graph from the St. Louis Fed, it shows the M1 money stock, which is essentially the readily accessible for spending money supply. So it's currency outside of Treasury, banks, etc. The currency has been going up quite a bit. And if you look at what happened, funnily enough, right around where the market bottom was, right around in March, the Fed started printing a lot of money. We went from $4 trillion here in the money supply. I think this is 4 trillion, so it's $5,000 billion, which would make it $4 trillion. As of March 9th, 2020, all the way up to $5 trillion in May. So 2 months, there was $1 trillion printed, and that money has to go somewhere, right? And where does it go? It probably goes to the thing that's probably going to grow in the future, and that's the stock market. Because if you look at this PE ratio, it looks pretty high at a 30, but you have to compare it against other investments that may be out there. And really the other investments that people talk about when they talk about other investments in relation to the stock market is bonds. And alongside the unprecedented printing that the Fed has done, I mean, the Fed has been certainly printing a lot since 2008, but it took a while for it to go from, 1 trillion to 4 trillion. It was across 10 years, and then we went from 4 trillion to 5 trillion across 2 months. So that money has to go somewhere, and it's certainly not going into bonds. And the reason it's not going into bonds because the 10-year treasury is yielding 0.8%, and that is terrible in relation to what it's historically yielded. So you can kind of look at the stock market as a proxy for alternative investments, and these alternative investments in this example, bonds are just yielding absolutely nothing, and they're not good investments. So all that extra money doesn't seem like it's going to flow into bonds because those investments just don't look very appealing. So it's flowing into stocks, and that's kind of causing stocks to have a really, really nice resurgence, despite the fact that there's a lot of fundamentals out there that may be pointing to a negative trend. You can look at unemployment being at 13.3%. You can look at the pandemic still being around. You can look at the civil unrest and say, oh, this is going to affect earnings. That's true. Forward earnings are probably going to be impacted, but you got to remember that the market is very forward looking. Is this going to impact the earnings 2 years down the line? Is it going to impact the earnings 3 years down the line? And right now the market is saying not really. There may be short-term impact due to all these things, but if I look at the earnings in 2021, if I look at the earnings in 2022, the pricing is baking in a recovery. Because if you think about this 30 PE over here that you've got on the stock market, you got to look at it in relation to the bonds. And these bonds at 0.82% are essentially equivalent to like 125 PE. By that I mean that you're paying $125 for each dollar in earnings, whereas over here you're paying $30 for each dollar in earnings. Bonds don't have earnings, but that's kind of a comparison. Whereas if you look at this, even 2 years ago where the market was kind of in that 28, 29 range, let's go back to the table here, right? So even in 2018, you were getting a 33 PE for the stock market, or 2017, you were getting a 28. Good time to buy 2017. By the way, if you look at what was happening with bonds back then, you have 100 divided by 2.58. That's a comparable PE of 38. So they're kind of in line, right? You're looking at a 33 PE in the market and a 38 PE on the bond side. It's not really a price over earnings again, but it's kind of what you're paying for each dollar that you might get back for each dollar coupon. And on the stock side, these earnings will grow. On the bond side, they will not. So when you're looking at that, it's kind of like, well, my stocks, I'm paying $33 for that. My bonds, I'm paying $38 for each percent of yield potentially. Is that a good deal? Maybe. So you can kind of point to potentially there being an alternative investment in the bond side. Now, when you look at it, you've got a $30 PE on the stock side. You've got a $125 PE on the bond side. That is not a good alternative. It's very hard to make sense of investing in bonds when you've got a 0.8% yield on them, right? You can kind of go back to 2000 to kind of illustrate this point more as to why the stock market was overpriced back then and why it crashed afterwards. You had a 43 PE in 2000. When you look at the bonds, you had almost a 6% yield, right? So you're looking at a comparable PE of about 15. So it's about 2.5 times higher on the stock side than it is in bonds. And I can look at those and say, man, maybe if I have to pay $43 for each dollar of earnings on the stock side, and I can get $15 for each dollar of yield on the bond side, maybe I'll go into bonds, because that trade-off isn't that great on the stock side, right? Sure, those earnings will grow, but how much do they have to grow to catch up to that 15? They have to grow quite a bit. And now when you look at the reverse in 2020, even though you're paying more than you've historically paid on the stock side, the alternative just is terrible, right? You can put it into bonds, or you can put it into cash yields that basically get you zero, right? So there's no growth at all. So even if stocks return 1% or 2% or 3% in the next couple of years, the assumption is that that's still better than what you can get in bonds. It's still better than what you can get in cash. It might not be better than what you can get in real estate or other investments, but for the most part, a lot of people just have the choice of bonds and stocks to choose from. So that's kind of where this abrupt growth is coming from, right? There's just so much money being printed by the Fed. That money has to go somewhere. And when people choose to invest it, they look at, they look at bonds or they look at stocks. And right now, stocks just look a lot better. So that's why you've seen such good growth in stocks. And the market is essentially just saying, hey, I know there's uncertainty out there, but I'm underweighing the certainty to a big extent because the alternative investment just aren't there for me, right? If the bonds were yielding 5% today, and this was what I was paying for a stock, then I'd probably be like, man, I'm going to sell all my stocks and go into bonds because I really don't like what could happen to stocks, because these stocks could certainly go down in price, right? This doesn't mean that because all of this money is being printed, it's going to hold up the stock prices forever. It just means that right now, a lot of money is flowing into stocks, so prices are rising on the expectation that earnings will eventually get better and return to growth, right? If things happen that are negative to those expectations, that change those expectations, stocks will certainly drop in price. And the valuations you see on stocks today might not be that attractive in relation to what they could be a year down the line or a couple of months down the line. There's a lot of volatility out there. But right now, the expectations are what they are, and the stocks are rising in price because so much of that money is going into the investment that are just looking better right now. So that's why you see, when you look at the S&P 500 6 months back, you kind of see the March bottom and then expansion from there, because that expansion, if you kind of line it up against the money chart, and let me see if I can make this closer to like a 1 year deal, right? It's relatively static, and then hey, March kind of comes around, and if you kind of look at March 23rd, this is where the big money starts growing. You go from March 16th, boom, 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 boom. And now it's kind of flattening out, right? So there's not a lot more money being printed, so it's potentially now this is kind of where the market starts to flatten, because if it's following this curve, it's all this money is flowing into the stocks. Stocks are getting priced up because more money in the system means more money into investments, which means those investments are just more desirable. And if there's more demand, prices go up. If that demand kind of stops and becomes even, then potentially in the near term the market will even out again if it's following the money supply like it seems to have been. But who knows, really? Who knows? And that's why investing is such a long-term game, right? That's why people who are saying, hey, this is going to get worse before it gets better because of X, Y, and Z, they kind of missed the run-up because they weren't following the response that the Fed made to essentially stopgap what was happening in the markets, right? And provide liquidity to companies that needed liquidity, and provide money to individuals that needed money, et cetera, right? And this is just the money supply that's out there. The Fed was also doing a lot of other stuff, like buying bonds from companies to give them liquidity, buying bonds from municipalities now to give them liquidity, et cetera, et cetera. So there's a lot of money being injected into the system, essentially, and that money has to go somewhere. In this case, it's going into stocks, and stocks are rising again, right? And potentially they'll go back to all-time highs, and potentially they'll keep rising. Who knows? Again, there's a lot of uncertainty ahead. Like I mentioned, civil unrest. Is there going to be a second wave? We're opening up the country quite quickly. Is that too early? Is it too fast? Is it going to lead to further waves down the line? Who knows? Right? So certainly this is a stock market that's not risk-free by any means. Just because the Fed printed more money doesn't mean that, hey, the market's going up forever. The Fed's going to keep printing forever. Eventually the printing will stop. The additional money supply will stop. And the stock market kind of has to stand on its own then. So hopefully that gives you an idea of why I think the stock market is doing as well as it's doing, despite all of the negative news that's potentially out there now and in the future. There's just not a lot of alternative investments, and that's why stocks have done really well, and I've kind of benefited from that within my portfolios. Initially tech was killing it. So if I look at my industry investments portfolio, which is really heavy in tech, the last couple of months they've kind of mirrored what the S&P 500 has done. But if you kind of look at the bottom, or even a 1-year approach for the S&P 500, I'm up about 40% on this portfolio in that time. The S&P 500 is up about 28% or so. So this has done really well in that time frame. And a lot of that is just because I'm invested in a lot of tech companies that have done really solidly in a market that's negatively impacted other industries, right? Working at home benefits tech. Staying at home benefits tech. A lot of companies that were impacted by the pandemic really were companies that are old school industries. Tech wasn't really that heavily impacted, so companies here really stood the test of time, and I've done pretty darn well. Obviously, there was a dip. If you look at the portfolio here, there was a dip that, we went from $130 down to $100. So yeah, it fell 30% just like the market fell, but it's recovered much quicker since then. So since that bottom here, it's up 40% year over year. It's up 40%. Really big focus on financial technology, AI, cloud technology, e-commerce, which has been just absolutely fantastic here. If you go back here, my e-commerce is up 133% on a time-weighted basis, AI, cloud, etc. 80%, pets and animals 50%, financial technology 50%, autonomous vehicles 45%, entertainment, which includes some tech companies, 38%. The only really negative performers here are aerospace technology, which is actually up again, surprisingly, but this is, companies that are involved with transportation, air transportation, not really the plane side of things, but more the tech side of things, which is why it's still doing okay, because it's still more technology focused, like companies that I think will be involved in the future space race or space creation if and when that happens, right? Those companies are going to need a lot of tech to power the spaceships. These are the companies I think are going to be involved in that, and I think those are still doing well. This isn't necessarily like, hey, I own Delta Airlines because it's an aerospace company, right? It's more like I own Raytheon, I own Microsoft, I own Teledyne, I own Qualcomm, Facebook, Google, Analog Devices, Lockheed Martin, companies, HEICO, that are going to be involved in not only the creation of the spaceships, the tech that's involved with them. And even if that doesn't happen for 5 to 10 years, because it probably won't, these companies are still relevant today, and they're still involved in the aerospace industry today. But I think they can transition into other applications of that industry, and that's why I kind of have this as an industry bet. And really, the only loser in this portfolio has been the sin stocks. This has been like the beer companies, even though Boston Beer has been doing absolutely amazing. Everything else is kind of done mediocrely to okay at best, right? Altria Group, Diagos, Constellation Brands, some of these companies haven't done super well. They've made some poor choices, but that is still a pretty small percentage of my portfolio, so I'm not too worried about it. And I do expect things to turn around there once restaurants and things of that ilk start opening up again. So overall, I'm very happy with where this portfolio is. The growth has been absolutely tremendous. If you kind of look at the activity, there's some buys here and there, some dividends, but not a ton. A lot of it has been growth, some deposits, but a lot of it has been growth as well. So, I'm not going to complain about a market gain of $3,000 after cash flow of about $16,000 and small dividends, but this portfolio does pay dividends a bit. So then my other portfolio, if you want to look at it, is the Dividend Aristocrats portfolio, which has actually recovered very well in the last couple of weeks, as a lot of these companies are old school companies that were more impacted by the pandemic than the tech focused portfolio I talked about before. These are your stalwarts that have paid dividends for 25 years in a row, and not only paid them, but also increased them. So I think I mentioned this on the last video, but I had to remove Roast, or is it Ross, R-O-S-T as the ticker, Ross Holdings, Ross Stores, because they suspended their dividend. And that essentially means that if you suspend your dividend, you are no longer a dividend aristocrat. You have no longer raised your dividend for 25 years in a row. So you are out of here, buddy. And I've reallocated those dollars to other companies, and you can kind of see that sale coming through over here. where I sold ROST. I reinvested that into other companies, McCormick, S&P, Johnson & Johnson, Medtronic were the main beneficiaries there. That will probably, hopefully, stick through this crisis. Excuse me, I had to sneeze there. And continue growing and paying their dividends. So if you look at the last week, really the last month, this portfolio has done really well, up 16%. It was actually down quite a bit. I think last time I did an update, we were still in the negatives. But the portfolio has really turned it around. If I look at the portfolio itself here, I only have returns back to April 2nd because that's when Raytheon, or United Technologies and Raytheon merged and split into Raytheon Tech, Carrier, and Otis. And the returns just aren't there for those companies before then. But the portfolio is up 24% since that time frame. That's a bit lower than the S&P 500, which is up about 28%, I think, since the start of April. And that's just crazy for the stock market to be up, essentially 28% in 2 months. But I'm sort of trailing it a bit here, but that does happen sometimes. Long term, as I've talked about in previous videos, this portfolio has a tendency to beat the market. It has since 1991 when it was kind of first started being tracked, because this portfolio is very simple. It's essentially, hey, if you're a dividend aristocrat, you've paid and raised your dividends for 25 years in a row. Right now there's 65 companies like that. It used to be 66, but Ross Stores was removed. You're in the dividend aristocrats, and I weigh those equally, 3 to 4 per 3% to each company or whatever in this slice. Some of them get a bit higher because of the way this is designed, but in general, that's the way the portfolio is designed, and this essentially is similar to the ETF Noble. But I just do it on M1 Finance because it's free and it's easier and more fun to track. So a bit behind the S&P 500 right now. This portfolio, again, is focused on dividends. If you look at the last year, they've paid out 292, but the portfolio has grown a lot since it started in the beginning of the year. I was at $4,000. I've been putting a lot more money in there. I'm at $20,000 right now. The dividend payouts are getting bigger and bigger. I mean, when I first started this, I was talking like 5 cents, 6 cents, 7 cents for each of these dividend payouts. But right now I'm still small numbers, but hey, a $3.77 dividend, $1.37 dividend, $1, $2.11, $1.24, $1.04, $1.89. That stuff adds up. It's not gonna pay my bills or anything like that, but eventually it will, right? If you look at some of these numbers, they're over $1 now, right? When I started a year ago, I think a year ago when I started this portfolio in January or December, whenever I hit $4 in total dividends. Now individual stocks are almost paying me $4. People's United gave me $3.62. AT&T gave me $3.15. AbbVie gave me $3.77. So, hey, I'm getting there. This portfolio is growing. It's throwing off cash that I'm reinvesting into all of these companies. And as long as these companies keep raising their dividend every year, they're going to stay in this portfolio. And what I like about this portfolio is that it's very easy, right? It's like, hey, this is the strategy. You're a dividend aristocrat. You're in. You're not. You're out. So that's why I removed Ross Stores. Everything else stayed the same. There's probably going to be some companies that cut their dividend and or fail to grow their dividend in the next year that might have to be removed. But I'm hopeful there aren't many. But again, we'll see. And if companies cut their dividends, I'll just remove them and I'll move them to all of the other companies that are continuing to pay and raise their dividends. So the winners here, there's a couple of companies that have done well. Ecolab, Clorox, for obvious reasons. A lot of people buy in disinfectants. Synthes Corp, AbbVie, Cardinal Health. A couple of losers here: Cincinnati Financial, ExxonMobil, Consolidated Edison. Anything gas related, anything related to insurance and financials, as yields have gone down, hasn't done super great. And then if you go to the other one, Raytheon's a bit misleading because that was a split. But there are a couple of companies that are underperforming. But in general, there's a lot of companies that are doing very well here. So overall, I'm still very happy with this portfolio. It's doing what it's meant to do. If you look at the drop between the top here to here, let's just go back to a quarter, see if we can capture that. I guess I can't. I went from 12,000 to 9,000. That's about 20%, 23% maybe. That's a bit less than the other portfolio, a bit less than the industry-focused portfolio, a bit less than the S&P 500. And then it started going up again. And now it's as a lot of these companies that are in industries like real estate or retail or energy that are overly impacted by this pandemic, as that kind of seems to recede, these companies are starting to do a lot better, and they're returning to healthy values really quickly, which is good and bad. It's bad for me because I'm in my growth stage and I really wanted those cheaper prices to stick around longer. But again, it's good because a lot of people are depending on these companies for income, and it's good to see them returning back to healthy prices again. And again, I'll keep contributing money to these portfolios as time passes, and I hope to see this growth continue. But I'm aware that there's potential for volatility in the next 6 to 12 to 18 months. There's still a lot of unknowns out there. And I'm going to keep buying. Again, this channel is called Time in the Market. It's all about putting money in the market and seeing it grow and seeing it spit out more dividends, seeing it spit out compound growth. And we're going to keep doing that. We're going to keep doing that through ups and downs. We had some downs. We're having some ups now. Maybe we'll have some downs again in the future, but hopefully we'll see what happens. Hopefully the pandemic isn't as bad as it was feared. Hopefully the second wave is mild if it comes. Again, a lot of that is going to impact stock prices, but there's just so much stuff going on out there that is more important than stock values right now, that I'm hopeful that you guys are really keeping all that stuff in mind when it comes to looking at the stock market. It doesn't really matter. I'm a long-term investor, so I don't pay attention to these prices in the short term. I'm just really concerned about what's going on in the world, and I'm hoping that we have a path to get better.